Namaste, good morning. We are continuing our understanding into depreciation. Well, before going into it, a small recollection of whatever we have been studying. In the yesterday's class, we saw the applicability of section 28, the basis of charge. We saw what are all the items that are taxable there, the related case laws with regard to basis of charge, and then went to section 29, which said how to compute the business income. Then we walked into section 30 to 37, that is expenses expressly allowed. We saw section 30, expenses in relation to building, 31, plant, machinery and furniture, and 32, the long travel depreciation. In depreciation, where are we? We are just trying to understand this format of computation. We know the four conditions for claiming depreciation. Should be a specified asset. Land and goodwill are not specified asset now. Should be owned by the assessee. The term ownership means beneficial ownership. Should be used for the purpose of business or profession. The term usage means both active as well as passive usage. And block of asset method should be followed. We are just in block of asset method and we saw the format. Opening WDV, additions. We saw that the last year's closing WDV will be the current year opening WDV. One exception we will study in optional tax regime. Additions are bifurcated into 180 days or more, less than 180 days. Additions are bifurcated into additions put to use based on the date of put to use. That is what is important. 180 days or more, less than 180. In that, we are looking at what is addition, what are all will be included in the cost of addition. The most important thing we understood is section 43A. Income tax law does not go by the concept of restatement. And between the date of payment, recorded historic rate or transaction date, and whenever the payment takes place, the adjustment will be made. Please remember the payment, when the payment is made, even the asset might not exist also, but still the adjustment will be made to the block. If the block is there, we should make the adjustment. My camera is not blurred. Yeah, we progress to special cases of addition. Section 43 is a support section. Section 43, my dear friends, supports other sections. So here again, we saw yesterday that 43.5 is the one which defines what is plant, what are all the inclusions in plant. Now again, we are going to section 40 and 43A tells us how to account for forex. We are again going to 43 to understand in some special cases how to record the asset value. Okay, how to record the asset value. That is what we are going to see now. the most popular cases amongst them is purchase of a second hand asset. What is the value that can be recorded for the purchase? For a second hand asset, what is the value? Actual price or fair market value, whichever is less. Actual price or fair market value, whichever is less. You will wonder why this provision at all. Imagine a circumstance where an asset is used by the holding company. Asset is used by the holding company for 3-4 years. So they would have claimed maximum depreciation. Now they are transferring to the subsidiary company. Subsidiary company is purchasing a second-hand asset. The holding company should not transfer it at a higher value so that the subsidiary can again start claiming depreciation. Actual price, or if you go and buy in the market, what would the price fetch? Fair market value, whichever is less. Okay. This is the first thing to understand if you buy a second-hand asset. Again, one other concept is sale and buyback of same asset. I sold an asset. I am buying back the same asset. It is not prohibited. I cannot prohibit it, but I can only restrict it in terms of value. Okay. What the income tax law wants to ensure is you are not buying back at a price higher than what it should be bought back. Okay. Because if you buy a computer for a few lakhs, in 3 years 40% the rate would have been very less now. You purposefully sell it to a related party or somebody and buy it back again at a very higher price. Okay. Asset earlier transferred, now acquired, now recovered. Book value at the time of transfer or actual cost of reacquisition, whichever is less. Book value at the time when you transferred, what is the book value? Okay, up to that you have already claimed the depreciation. For the remaining you can claim. When you transferred, what is the book value or cost of acquisition, reacquisition now, whichever is less. Whichever is less. So these two value at the time of transfer. As per income tax law. Whenever we say books, here we are talking about income tax books. Okay, the question was, is the book value, the terminology book value, value prevailing in the books of accounts or value prevailing as per income tax law? It is as per income tax law. Okay, so that is the value you can record it. I'm looking into question number 4, part 1. I'm looking into, it's in page 24, question number 4, part 1. Ramesh, after purchase and put to use on 15/12/2018 a machine worth 3 lakhs which is eligible for depreciation at 15%, sold this machine to Ganesh on 1/1/2021 for 3,20,000. Fair market value on that date was 2,50,000. Ganesh, who after using the machine for his business purposes, sold it back to Ramesh on 15/11/21 for 3,10,000. Compute the amount of depreciation and capital gains for various years, assuming this was the only machine in the block for both Ramesh and Ganesh. Read it. So for Ramesh, there are two things. One, he has purchased that machine, transferred that machine in the financial year 2021. Okay, he is transferring it to Ganesh on 1/1/21. Transferred in the financial year 2021. Reacquired the machine in financial year 21/22. This is from Ramesh perspective. From Ganesh perspective, he purchased a second-hand machinery and which later he transferred. Okay, right? Purchase value as on purchase value as on 15/12/2018. Purchase value as on 15/12/2018, 3 lakhs less depreciation at the rate of 7.5% for financial year 18-19. We all know depreciation at the rate, because it is purchased in the month of December, less than 180 days. Okay, so we need to do half of the eligible depreciation. For a minute, we will ignore additional depreciation and all. In the classroom, we are yet to see though. Okay, WDV as on 1/4/2019. Depreciation at the rate of 15% for financial year 1920. WDV as on 1/4/2020 is 2,35,875. Opening WDV as on 1/4/2020, 2,35,875 less sale consideration. In that year, in the financial year 2021, he has sold the asset. You can see he sold the machine to Ganesh for 3,20,000. He sold the machine to Ganesh for 3,20,000. So sale consideration 3,20,000. Sale consideration 3,20,000. It results in, okay, short term capital gains. Okay, STCG. Okay, since the block is gone, since the block does not exist, this is the only machinery, so the block is gone. So it will be, he results in a short term capital gain of 84,125. 84,125. STCG 84,125. This is for the financial year 2021. This is for the financial year 2021. Okay, so opening WDV as on 1/4/21. Okay, opening WDV as on 1/4/21 is nil. Is nil. Now, addition, reacquiring the same asset. Assessee is reacquiring the same asset during the year. The question says, okay, after using the machine, sold it back to Ramesh for 3,10,000. Sold it back to Ramesh for 3,10,000. Okay, according to section 43, subsection 1. Okay, cost of addition will be, okay, value prevailing in book at the time of transfer, okay, which is 2,35,875. Value prevailing in the book at the time of transfer, 2,35,875 is the value prevailing, 1/4, okay, or actual reacquisition price, which is I think 3,10,000, which is 3,10,000. Okay, whichever is less. So I can only record 2,35,875. I can only record 2,35,875, where an asset which has been transferred is reacquired by the assessee. The price of reacquisition, the cost of addition will be either the book value prevailing, okay, at the time of transfer. Always in income tax law, book value means 1/4. Income tax depreciation is a 31st March concept. Before that date, you cannot provide income depreciation anywhere in income tax law. Income tax law, depreciation can only be 31st March. Not like other laws where you can provide 9 months, 6 months. The proportionate and the concept itself is absent here. So, book value means this value, okay, or actual acquisition price, okay, less depreciation for financial year 21-22 at the rate of 7.5% again, because it is acquired in November. So put to use for less than 180 days. Closing WDV as on 31/3/21. 22, sorry. There is no way we can claim it back. It is a short-term capital gain. I understand, since we are reacquiring the asset and put it in and recording it in the same value, is there a way by which we cannot? The law, the income tax lawmakers want to discourage this practice. So they are very clear. When the fair market value is 235 or whatever is the book value, you sell it at the book value, reacquire, then fine. If you sell it at a higher value, you are getting a benefit, pay the tax. Subsequently, I am denying that. This loss will not be transferred to P&L. Two things I will tell you. This is not loss. As per books of account, this is a profit. 2 lakh 35 was sold for 3 lakh 20,000. What loss is there? This, as per books of account, you will claim for 3 lakh 10,000. As per books of accounts, you would have recorded the value at 3 lakh 10,000 and claim. When it comes to income tax adjustment statement, addition to asset will be not 3 lakh 10,000, 2 lakh 35,875. The mismatch in depreciation, the deferred taxes, etc. Now I am going to the other assessee. In the hands of Ganesh. In the hands of Ganesh, how the provision operates. In the hands of Ganesh. Okay. Purchase of second hand asset. Purchase of second hand asset. The law says, okay, actual purchase price which he has acquired it for 3,20,000. Okay. FMV on the date of purchase, which is just 2,50,000. Okay. Cost of addition will be whichever is less. Cost of addition will be whichever is less amongst these two. So you can record only 2 lakh. As far as Ganesh is concerned, he is purchasing a second hand asset. Okay, he is purchasing a second hand asset. Okay, less depreciation for the financial year 2021. Okay, less than 180 days as he has purchased only in Jan. Okay, so 7.5% depreciation at the rate of 7.5% for that financial year. Okay, opening WDV as on, okay, 1/4/21. Opening WDV as on 1/4/21, it will be 2,31,250 less sale consideration. He has sold the asset who, after using the machine, sold it back to Ramesh for 3,10,000. So 3,10,000 short term capital gain. Okay, as the block ceases to exist. Okay, short term capital gain for the financial year 21-22 as the block ceases to exist. It is 310 minus this one, 78,750. They can sell the asset at a higher value. Yes, 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 yes. Generally, the intention of the law is to discourage this. That's why you find both of them paying capital gains tax, both of them having depreciation at a lesser rate of 7.5%. Actually, the machine is in use for 3 years, but you would have claimed 1 year 15%, next year 7.5% one assessee, 7.5% third year one assessee. So the purpose of the law is to discourage this practice. That is why they have made such a provision. So whenever an asset is sold and reacquired, suppose if there is an adjustment in the main question and they give you the fair market value, the reacquisition price being higher, take only the fair market, I mean book value, or the price whichever is less. Progressing forward, suppose I have been using an asset for my personal purposes. I have been using an asset for my non-business purpose. Now I am bringing that asset for business. Understand the case? I have been using this asset for non-business purpose. Now I am bringing the asset for business, into business. At what value can I record? Okay, at what value can I record? The law is straightforward and simple. Had the asset been originally itself purchased for business purposes, what would have been today's value? When I say today's value, always 1/4. Okay, practically speaking, it can even be today. Okay, right? October 18th, the asset has been brought into the books as business asset. But the value I can get only as on 1/4/21. Next time the value changes only on 31/3/22. So what would have been the book value had the asset been originally itself purchased for business purposes? Okay, that and the subsequent aspects also will have the same thing. Okay, asset acquired by way of gift or inheritance, be it this, or asset brought into business for business purposes subsequent to its acquisition. Depreciation, that would have been on the actual cost of the building. All allowable had the building been used for business right from the date of its acquisition, as the building being used for the business right from the date of acquisition. The same for somebody gift an asset. Okay, original cost minus depreciation till the date of gifting, and you should take it. Okay, Sudarshan purchases a building for rupees 20 lakhs on 22nd April 2017. He has been letting it out till 10th July 21. The tenant vacates the said premises on that date. On 11th July 21, he converts this business building into business for the purpose of carrying on his. Okay, so it becomes a business asset. The original question on top is compute depreciation for your financial year, which will include the computation of the value to be recorded in the books. Building, it is a building not for residential. They have clearly said that it is more of go down types, etc. So 10% is the rate of depreciation. Not for residential purpose. No, dwelling is more of business, small godowns, etc. The cost of addition comes to 1312200. 1312200. That is the cost of addition of the asset, because had the building been used for business from the date of its purchase, this would have been the 1421 value. This is our answer. That is 1,31,220 would be the depreciation for the financial year 21-22. Yeah, yeah. If they have introduced it in October or November, it would have been only 5%. The same principle holds good for a foreign company transferring asset to Indian branch or Indian subsidiary. A foreign company which has used some assets, after some period they are transferring it to India for their Indian branch or Indian subsidiary, whatever it is, the same principle. Had the asset been used in India or by the Indian entity from the date of its acquisition, had the asset been used by the Indian entity from the date of its acquisition, what would have been its current value? That can only be recorded. No, need not be a related party. Anyway, need not be a related party. Today, the question is, how do we know the actual purchase cost of the asset? Today, exchange of information is freely available between countries. They can easily get it from the other country. From the other country tax department, they can get when this asset was acquired by your assessee in which year. Second means, yeah. See, if you mean to say the present which we are on the building, yeah. See, a foreign company or an asset which is used outside India is now brought into. So far, depreciation is not claimed on that asset in income tax law of India. Now you are bringing it in India. It's a foreign branch or subsidiary. They suddenly put an extraordinary value for that asset. Income tax law want to discourage it. Had the Indian entity been using the asset right from the date of its acquisition, what would have been its value? That can only be recorded as the value of the asset. Third question. A foreign company purchases a computer on 10th November 2017 for $12,000 and a biogas plant on 30th June 2018 for $20,000. These plants were used outside India for business purpose. On 1st March 22, even though it is so, I can only find the value as on 1/4/21. Okay, but as our friend was also saying the last question, since it is 1st March 22, this year I can only claim 7.5% or half of it, not 7.5. The company starts manufacturing unit in India and transfers them to Indian factory. Find out the actual cost to be recorded. Depreciation for computer 40%, biogas 40%. Hmm? Stand corrected. Depreciation at 20%. I stand corrected. The value to be recorded, I am getting it as 93,212 and 2,16,000. The value to be recorded by the Indian entity is 93,312 and 2. Had the asset been used in India from the date of acquisition, this would have been the value. Any doubts, please ask me. Shall I move on? Shall I move on? Okay. Okay. Now, coming to one of the important aspects which we will travel through the whole of the law. What happens to the transfer that takes place in the case of amalgamation, demerger, conversion, holding to subsidiary, etc. We call it as succession of business. Okay, we call it as succession of business. In the case of amalgamation, demerger, conversion of firm into company, company into LLP, sole proprietor into company, holding to subsidiary transaction. In all these cases, the value to be recorded in the books of transferee company is the value that is prevailing in the books of transferor company. The value to be recorded, okay, W transfer by holding to 100% subsidiary, amalgamation, demerger, the value to be recorded is the value prevailing in the books of transferor. Okay, transferee company can record, transferee entity can record only in the price prevailing in the books of transferor. This is the case we just worked out. Asset acquired by non-resident but brought into India for purpose of business. Actually, that's what we worked out. Conversion of stock into, yesterday we saw, I told you, wherever it is getting converted, it is treated as sale. It is treated as business income under section 28. So they will record the fair market value as the sale value, as income, and that becomes the cost of the asset. Okay, this is the condensed table of section 43, because if you take the material and see, okay, I know you are not going to take, but if at all okay, ஒரு ஆர்வக்கோளாறுல if you take the, because all these things will be given as separate cases in the material, so you will see the table as very lengthy, but this is what, am I clear to you? Okay, about amalgamation we'll soon come and see. So back to the table, back to the format. Okay, so addition, we are now very clear what will form part of addition and what are all the special cases of addition. Why we are splitting it into 180 days or more and less than 180, as we discussed. More than 180, full depreciation, half of the eligible depreciation. Whatever is the money pay receivable, our friend has corrected us, money receivable, okay, on sale or discard of asset. Yesterday we had a discussion on this. Yesterday we had a discussion on this money receivable on sale or discard of an asset. Our friend, if at all there is any asset which is scrapped but nothing is realized, nothing can be reduced from this block. There should be a monetary value. When we go to capital gains chapter, we will further understand that insurance compensation on destroyal of an asset is money received on receivable. That's why not only sale, discard of an asset, destroyal of an asset, all these things are clubbed here. We'll get the depreciation as the answer. Coming to the next core concept, okay, right, this depreciation under income tax law can only be on diminishing balance basis, okay, except electricity companies, which has the option for following straight line basis. All other entities only diminishing balance. And in income tax law, depreciation is not optional, it is mandatory. Depreciation is not optional, it is mandatory. Suppose an entity is there which can claim exemption under section 10 for, let us take 5 years. 100% of the profits are exempt. So what they would prefer is they will not claim depreciation for the first 5 years, because they can show a higher profit and claim the benefit. After that, they can start claiming the benefit. To discourage such practices, to ensure that what is profit, okay, depreciation is mandatory under income tax law, okay, and only diminishing balance method except electricity company. Now we are going to the second limb of depreciation. Whatever we have studied so far, we can call it as normal depreciation. The next is additional depreciation, in addition to what you are claiming. That is why it is known as additional depreciation, only for associates who are there in manufacture or production. Okay, so not for trading sector, not for service sector, nothing. Only for associates who are there in manufacture or production. Okay, which includes generation and distribution of power, okay, power sector also, only for new plant and machinery, only for additions, and that too it should be a new planted, second hand plant and machinery, it will not, be it imported or domestic purchase. I have a reason for telling you. By tomorrow you will be very clear why I am saying imported is also for this section. Second hand imported machinery will not be treated as new. Okay, okay. please write and keep somewhere, and there is a reason for me repeating this. You cannot claim additional depreciation for second hand machine. Okay, please write it and keep somewhere. I have a reason for selling this. For section 32, additional depreciation hyphen new means both for import and for domestic purchase. Full stop, continue. Imported second hand machinery is not a new machinery. Imported second hand machinery is not a new machinery. Okay, when we are going to do tomorrow section 35 AD, later when we are going to see section 80 IAC, in those sections, imported second hand machinery is a new machinery. In those sections, that's why I am making it very clear here. Imported second hand machinery is not a new machinery for section 32. Okay, keep it somewhere. Okay, I will come back to it. Okay, rate of additional depreciation is 20%. Only for plant and machinery, my dear friends, which are used directly or indirectly in facilitating the manufacturing process. Okay, it should be used directly or indirectly in the facilitating manufacturing process, not for intangibles, not for building, not for, it is only for plant and machinery. Okay, rate of additional depreciation 20%, law of interpretation. If the asset is used for less than 180 days, half of the eligible depreciation, so you can claim only 10%. If the asset is used for less than 180 days, 10%. There was a case law, okay, forgings, okay, which became a law now. The finance minister in the budget and the act promises me 20%. They say that to promote manufacturing sector, I am giving this additional depreciation of 20%. But if I purchase an asset and put to use for less than 180 days, interpretation says where an asset has been purchased and put to use for less than 180 days, half of the eligible depreciation, so 10% can only be claimed. Law promises me 20%, but interpretation reduces it to 10% for asset purchased after October 3rd or so. Harmonious construction, both has to be given effect to the intention of the finance ministry. So in that forgings case law, the court said where only 10% is claimed in the first year, because it is used for less than 180 days, only 10% is claimed in the first year. The balance 10% can be claimed in the immediate succeeding year. The balance 10% can be claimed in the next year. Okay, so that I am ensuring that the law is also fulfilled and the intention of the finance minister is also fulfilled. It is now becoming a law, no more that case law. Okay, assessee beneficial provision, where in the first year assessee claims 10% since the asset is put to use for less than 180 days. Balance 10% can be claimed in the immediately succeeding year. Okay, so that 20% you will get, okay, 10% in the subsequent year. Okay, later when we are going to study 115 BAB, we are going to say you cannot claim additional depreciation. Okay, I'm just giving you a small hint we'll see there, we cannot claim additional depreciation if an assessee is opting for 115 BAB. Last year I purchased the machine, second half I claimed only 10%. This year I am supposed to claim the balance 10%, but this year I am claiming 115 BAB. So that 10% cannot be claimed. So the law is giving me a benefit, increase the opening WDV accordingly. அதனால தான் I told you opening WDV is normally the last year's closing WDV. There is one exception in optional tax regime. Okay, we'll see it more there. Okay, and this note. Okay, this is more for your practical, if not for your examination. Additional depreciation can be claimed even if the block is gone out of existence. Additional depreciation is not on amount balance available for depreciation. It is on the purchases made during the year. So this can be claimed even if the block ceases to exist. Read through, please. Online students, Sudha Hariharan, can somebody be confirming me that yesterday's problem is not there today? That is,
Yes, sir. It is not there.
okay, thank you.
Yes, sir. It's clear, sir.
Okay. Yeah, go ahead, Antonio. You can still claim 10%. The question here is, what if in the first year I claimed 10%, next year I have sold the machinery? The answer is still you can claim the balance 10%. Here the conditionality is you should have purchased the machine and used it for the purpose of this manufacturing. Okay. Anyhow, when you sell the machine, the block value reduces, your normal depreciation reduces, all those things are there, but you can still claim. In examination, the most popular is additional depreciation. The most popular. Okay. If you on the top of it, when we read a question stating it is a manufacturing entity, be clear they are coming to additional depreciation. Okay, one of the adjustment will be additional depreciation, and the adjustment will be as silly as that normal depreciation is claimed by the assessee. So which means you are supposed to claim the additional depreciation because you are all chartered accountants. We are all. Question number 5. Marmakam Limited, engaged in the business of manufacture of computer hardware, gives you the following particulars. Rate of depreciation, of course, the block 3 is only 40% now, but that doesn't matter because that block is going to go out of existence. Okay, but block 3 now it should have been only 40%. Opening WDV, additions of new plant A, plant B, plant C, sale of old plant. Plant A and C were put to use in September, whereas plant B is only in the last week of March. Very interesting question. Just for your understanding, if not for your examination. Okay, first we will understand, then we can do some other questions which are purely more of examination oriented. சொல்லு Sriram, you want something? Here I'm correcting it as 40%. It's an old question, so I have maintained it as 60. But now the maximum rate is only 40. So here in the solution, I'm correcting it as 40%. Block C is gone. Block C is gone. We get a short-term cap. When will a block cease to exist? In two circumstances, a block cease to exist. One, when all the assets in the block are sold, that we saw. Second, when the sale consideration exceeds the balance available. Okay, opening plus additions. Okay, this is section 50 in capital gains. They say that it is a short-term capital gain. Block C ceases to exist. Okay, interesting things. Less depreciation. Normal depreciation for 1 minute. Balance available for depreciation for the first two blocks. Balance available for depreciation for the first two blocks are 74 lakh 92,000 and 30,000. Normal depreciation directly 74 lakh 92,000 into 15%. Into 15%. 11 lakh 23,800. For block B, only 30,000 is there into rate into 1 by 2 because it is belonging to the FIFO is the method. Okay. So old assets has been sold. Only the new asset value that is being reflected. So half of the eligible depreciation can only be claimed. The eligible depreciation is 30%, so half comes to 15%. half comes to 15%. Here the block is gone, so no normal depreciation. Repeating, normal depreciation of block 1 directly compute. Block 2, though the balance available is 30,000, it can only be apportioned to the last purchased asset, and the last purchased asset is less than 180 days. So I can only claim half of the eligible depreciation. Eligible being 30%, I claimed 15%. Additional depreciation. Additional depreciation for block 1, 57 lakhs into 20%. For block 1, straightforward, 57 lakhs into 20%. For block 2, 4 lakhs into 10%. 4 lakhs into 10%. And interestingly, for block 3, 17 lakhs into 20%. Okay, additional depreciation, okay, is on the addition, and it can be claimed even if block cease to exist. Okay, additional depreciation is on the additions made, and that can be claimed even if the block goes out of existence. Okay, closing WDV for block 1 it will be 52 lakh 28,200. For block 2 and block 3 it will be nil. Because of claiming depreciation, you will not get short-term capital gain. Block B, 30,000 is only there in the block, but you claim depreciation 44,500. Allowed? Yes, allowed. Yeah. Because of claiming depreciation, you will not be having short-term. Only because of sale you can have gain, not because of depreciation. Okay, right? And for the block that ceases to exist also, depreciation can be claimed. Okay, total depreciation, twenty-six lakh 48,300. 26 lakhs 48,300. Note 2 is furthermore interesting. The balance 10% on block 2 can be claimed in the financial year 22-23. Okay, because you claimed only 10%. Okay, in the additional depreciation for block 2 you have claimed only 10%, 4 lakhs into, okay, 10% only you have claimed. The balance 40,000 can be claimed in the immediate subsequent year, that is financial year 22-23. Take your time, look into the answer. XYZ Limited, a manufacturing concern, furnishes the following: opening WDV, new plant and machinery, 8th June, 15th December. Then you will get the closing, 17th April, 11th August, 3rd January 20. Compute the amount of depreciation and additional depreciation. Go ahead with the question. Go ahead and answer. This is the answer I'm getting, which majority of them are also getting. Online students, let me know if you have a different answer.
No, sir. Same answer we got.
Yeah. So in the second year, for the assets of 8 lakhs, I will claim 10%. And in financial year 23-24, for this, you can claim the balance 10%. So 12 lakh 90,000 and 15 lakh 87,750 are the depreciations for the respective years we can claim. Question number 7. Light and Powers Limited, engaged in the business of generation and distribution of power, furnishes the following particulars. Compute the depreciation allowable under Section 32. The company has opted for, since it is a power generation company, they always have the option of straight line also. But normally they won't opt for straight line. Straight line, there is no additional depreciation. There is no block of asset method. So they'll only prefer diminishing balance. Opening WDV, purchase of second hand machinery. Purchase of second hand machinery on 29th December. Purchase of new machinery on 12th July for power generation. Acquired and installed new air pollution control equipment 40% on 31st July. New machinery acquired and installed for the purpose of generation of power. Sale value of old machinery. Sale value of old machinery. So there are 1, 2, 3, 4. 4 acquisitions. One is an air pollution equipment which goes for 40% block. You can claim additional depreciation for it because it is directly or indirectly contribute for the generation process. Without that, computers, air pollution equipments, etc., these equipments which directly or indirectly contribute because they are also plant. It is available for plant and machinery, so you can claim additional depreciation for that also. For second hand machinery, you cannot claim, and the other two machineries are one on 12/7, okay, another is on 23/11. Okay, go ahead, try it out. Go ahead. Go ahead, friends, try it out. Where you stuck? Which normal? Plant and machinery. You got 15 lakh 93,000 as the balance available for the 5 lakh 25,000 into 7.5%. The balance into 15%. Okay. So we all know second hand machinery does not have, and in this the 3 lakh 25,000 you can claim the balance 10% in the next year. What is not new plant and machinery asset, whether used in India or outside India already, is not eligible for additional depreciation. Office premises, etc., vehicles, and assets on which 100% now that is not there, so don't worry about it. So, normal depreciation, additional depreciation. The third limb is known as unabsorbed depreciation, where the profits are not sufficient to cover the whole of the depreciation. Where the profits are not sufficient to cover the whole of the depreciation, the uncovered portion is known as unabsorbed depreciation. Okay. For example, if the gross profit is 15 lakhs, other expenses are 14 lakhs and depreciation, the net loss of 2 lakhs, though in accountancy we call it as net loss, but in income tax law it is known as unabsorbed because the loss is due to depreciation. That loss which is due to depreciation is known as unabsorbed depreciation. Okay. Similarly, if the gross profit 15 lakhs, other expenses 16 and loss depreciation 3 lakhs. The loss due to depreciation is known as unabsorbed depreciation. Why unabsorbed depreciation is essential? Because of set of chapter. Like why speculation business is essential? Because of set of chapter. Unabsorbed depreciation is also because of set of chapter. What is that? It can be set off against any income and indefinite period of carry forward. It can be set off against any income, indefinite period of carry forward. It can be carried forward even if return is not filed within due date. Even if return is not filed within due date. Why? Section 80 read along with section 139 subsection 3. 139 subsection 3, which we will see in assessment procedure, speaks about return of loss. Section 80 speaks about losses. Remember this. Section 80 read along with wonder. The law says all losses mentioned in section 70 to 79 in the set of chapter can be carried forward only if return of income is filed as per 139 before due date. Unobserved depreciation is not said in 70 to 79. Unobserved depreciation is said in section 32. So, chapter 6 losses. Chapter 6 is set off. But this is in chapter 4. So, by interpretation, we understood that unabsorbed depreciation can be carried forward even if it is not filed within due date and can be set off against any income. Okay. So, these are all the advantages. These are all the advantages. Okay. That because it is not spoken in section 6. Many of you think only advantages. There are disadvantages also. Presumptive computation. All expenses under section 30 to 37 are deemed to have been allowed. So, unabsorbed depreciation brought forward in the now, it is deemed to have been allowed because it is said in section 32. We will see questions we will do and see. And also in non-resident taxation, what they will say is losses mentioned in chapter 6 can be claimed. You cannot claim unabsorbed depreciation because the wording says losses mentioned in section 10. All deductions under section 30 to 37 and 56 IFOS 56 can be claimed as deduction, cannot be claimed, but losses mentioned in chapter 6 can be claimed. So unabsorbed depreciation cannot. So there are some disadvantages also, not if not many, but there are some disadvantages. The intention of the lawmaker is so. That's why it has not been amended. No, the intention of the lawmaker is so. That's why it is not amended. On behalf of the class, we all pray that you don't become finance minister. You seem to amend it immediately. Okay. The fourth limb of depreciation, which is again important, is proportionate depreciation. So we have been talking from yesterday, there is no proportionate depreciation, but now I am coming to a concept called proportionate depreciation. I still hold good, my dear friends, income tax law does not have the concept of proportionate depreciation. Here what we are going to see is not proportionate computation of depreciation, it is proportionate distribution of depreciation. Income tax law does not have the concept of proportionate depreciation. Have it clearly in your mind. It does not have. Okay, right. Let's talk about proportionate depreciation, what it is. My dear friends, whenever there is a business restructuring, this comes. Amalgamation, demerger, conversion. Two entities have to claim depreciation for the same asset. I converted my firm into a company as of today, 18th October. I converted my firm into a company. Till yesterday, firm should have claimed the depreciation for that asset. From today, company has to claim. The law says, first ignore such an event happened. The law, income tax law says, ignore such an event happened. Compute the depreciation in the regular format which we do. So there is no question of computing proportionate depreciation. Proportionate depreciation is not a concept. Such computed depreciation will be divided between the entities based on proportionate aspects. Okay. Proportionate depreciation does not exist. However, in the following circumstances, the concept becomes applicable. Amalgamation, demerger, conversions. In all the above said, depreciation will be computed ignoring the event. First, computed depreciation. And such computed depreciation will be distributed amongst entities on effective usage period. It has a relevance, that's why I have highlighted. On effective usage period. It has a relevance. It has something important to understand. Read through. May I? Okay. Question number 8. Smriti Limited has a block of asset carrying 15% rate of depreciation whose opening WDV is 40 lakhs. Purchased a second-hand plant and machinery of the same in on 1st November 14 lakh 40,000 and put to use on the same date. Smriti Limited amalgamated with Shruti Limited with effect from 1st January. Compute the depreciation that Smriti Limited and Shruti Limited can claim, assuming that the asset was transferred by Smriti Limited to Shruti Limited at rupees 60 lakhs. Okay. First thing to answer, lot of things to understand. First thing to answer is this part. This is not possible under income tax law. Section 43 tells us transferee can record the asset in their books prevailing, whatever is the value prevailing in the books of transfer or entity. So the 60 lakhs is not possible. In your books of accounts, it would have been different. Okay. But for income tax law purposes, it cannot be so. So I start the answer from there, from a note. that 60 lakhs is not at all an impact for us because you cannot record it at any other value other than what is prevailing in the books of transfer. Sorry. Shall I progress? Okay. Now I'm going to computation of depreciation, which is the normal method. At this level, please follow less depreciation for opening balance. I have a reason for this. For opening balance at 15%, for asset purchased on 1st November at 7.5%. I have a reason for this, so follow this method. Okay, okay. Apportionment of depreciation. What is the method of apportioning depreciation? Yeah, can you read it? Can you read it, please? Yeah, in the material. Yeah, the last line. Can you read it? No, 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 no. The theory. Depreciation will be computed ignoring the event. Such computed depreciation will be distributed amongst the entity based on effective usage period. It will always be in days, effective usage period. Remember, okay, for opening balance, okay, look at this. The entire thing has happened on 1st January. Smriti Limited amalgamated with the Shruti Limited on. So, Shruti Limited will be January 31 days, Feb 28 days, March 31 days. 90, and Smriti Limited will be 365 minus 90. 365 minus 90. Okay, so remember this, it is on the basis of effective usage period. For asset purchased on 1st November, for Smriti Limited, it will be 30 plus 31, 61 days. For Shruti Limited, it will be 90 days, totally 151 days. This is the most important wording. That's why I have highlighted effective usage period. The depreciation, such computed, till you compute depreciation, no change. Such computed depreciation should be distributed amongst the entity on the basis of effective usage period. So, depreciation on opening balance will be distributed 6 lakhs divided by 365 into 275. 6 lakhs divided by 365 into 265, 275. For additions, 1st November, 1,08,000 divided by 151 into 61. No, there one entity is no more there, another entity is there. That's all. Smriti is not there. Smriti Limited amalgamated with Shruti Limited. Yes. Yes. So once more, if you want an okay, for the opening balance, I did 6 lakhs into 275 divided by 365 for Smriti. For the addition, I did 1,08,000 into 61 by 151. That's how I got for Smriti Limited, and the remaining is for Shruti. Effective usage period. That is what the law says. Effective usage period, we need to be little cautious. We need to find out how many days the asset has been used. For computing depreciation, we are not at all looking at anything. We compute depreciation in the normal manner. While distributing, we have to distribute it on the basis of effective usage period. Shall we? 31 January, 28 February, and 31 March, totally 90 days. Okay, okay, okay. Pushpak Limited, a partnership firm, was converted into Pushpak Private Limited with effect from 1st November. However, the company commenced its operation only from 1st March. The opening WDV are plant and machinery and computer. Plant and machinery purchased 1990 and immediately put to use. No further information is available. Compute eligible depreciation for the firm as well as company. Please ignore additional depreciation, only the normal depreciation. Go ahead, the question is yours. This is the depreciation we are getting. 6,94,500 for plant and machinery and 4,44,000 for computers. Direct computation because it is more than 180 days. So 6,94,500 for plant and machinery and 4,44,000 for computers. This is the table of distribution. The firm is in existence for 30 April plus May plus June plus July plus August plus September plus October. The company's effective usage period is just 31. We are charging depreciation. When we computed depreciation, we computed for the whole year. Distribution is the firm gets a more amount of depreciation. Even the November to February period also, the firm is able to enjoy in a better manner. While computing depreciation, Raja, we did not make any difference. Yeah, but other things being constant. But the law has used the word depending on effective usage period. The yeah, exactly. It is not there in the hands of the firm. Firm itself is not there. Total days differs. Total days differs. Total days differs. Yes, yes, yes. So there are four limbs of depreciation which are important to understand. Normal depreciation, which we know how to compute. less than 180, more than 180. Additional depreciation, there we have to remember only for new, and if you are able to claim only 10% in the year 1, then in the immediate next year, year 2, you can claim 10%. Unabsorbed depreciation, the why the law interprets unabsorbed depreciation so, okay, why it can be carried forward for an indefinite period, etc., because it is mentioned in chapter 4. And proportionate depreciation, the most important thing to understand is effective usage period. Look for effective usage period and distribute the depreciation. So these are all the depreciations you have so far seen. Okay, right? And as I told you, okay, as we have been discussing, if you can take a small notes for this, okay, depreciation for electricity companies, depreciation for electricity generation and distribution of power for them, depreciation for electricity company, okay, they can either follow, okay, diminishing balance or straight line. Okay, they have the option of following either diminishing balance method or straight line method. Okay, if diminishing balance is preferred, okay, then depreciation as per block method. Okay, if diminishing balance method is preferred by them, block of asset, they can claim additional depreciation, all those things. Okay, if SLM is opted, okay, then each asset has to be individually depreciated. Okay, that is, in other words, no block concept. Okay, if straight line method is preferred, then there is nothing called block. Each asset has to be taken separately, even if there are 10 cars, 20 cars, 50 computers, 100 computers, each has to be independently and individually depreciated. Okay, each asset has to be individually depreciated. In the year of sales, suppose if an asset gets sold, okay, it's not block ceasing to exist and all. In the year of sales, sale value is less than book value of asset. If the sale value is less than book value of the asset, book value, let us take 1 lakh, sale value is only 70,000. Difference is charged as terminal depreciation. The difference will be charged off in the name of terminal depreciation. The difference will be charged off in the name of terminal depreciation. Sale value, okay, sale value is more than book value. Okay, okay, section 41, so it's a deemed income. Okay, balancing charge, it's a deemed income. It goes to section 41, it is a deemed income as balancing charge. Sale value more than original cost of the asset. Sale value more than original cost of the asset. Up to original cost, it is known as balancing charge. Okay, excess as capital gains. Okay, so I purchased the asset for 3 lakhs. Now the book value is 1 lakh. I am selling it for 4 lakhs. First 2 lakhs balancing charge over and above original cost, whatever we get is okay. We'll see this concept in scientific research and other things. You will be more clear. Just as a, I have never seen a question on this, but just as a concept, keep it. Okay, as I told you, even for electricity companies, written down or diminishing balance method is the better method to follow. Okay. No, there is no chance of capital. Yeah, yeah. Terminal depreciation. Terminal depreciation. So, 5 concepts of depreciations. Okay. Normal, additional, unabsorbed, proportionate, and depreciation for electricity company where straight line method is followed. These are all the 5 concepts of depreciation, which gives a holistic idea about how depreciation has to be charged. Let us go to some of the case laws and complete the discussion on depreciation. Okay? Yes, friend. Oh, I have given the theory. Sorry. I've given the theory. I thought the theory is not there. I thought I forgot to type, but I have given the theory. Sorry. No, income tax law does not have this concept of change in the method of depreciation. You opted it, you have to go with it. The transferring company can follow WDV, all these things. Okay. Okay. The first case, ICDS Limited. Okay. The company is in the business of leasing. Please understand. The company is in the business of leasing of vehicles. So what they do, they buy the vehicle, they fund the vehicle, okay, and the lessee uses it. Lessor funds it, lessee uses it. To avoid dual registration, they directly register it in the name of lessee. To avoid the dual stamp duties and registration process, they directly register it in the name of lessee. Okay. Assessing officer said lessor cannot claim depreciation on 2 grounds. One, or the title deeds are in the name of lessee. Two, asset is used by the lessee. So lessor cannot claim depreciation. You see, is the assessing officer correct? Yeah. I'll take that answer. That's a good answer. Technically, practically also, it's a one of the accounting concept which income tax also carries, substance over form. Formality is registration. Just because the vehicles are registered in the name of the lessee, it doesn't mean lessor. Lessor is the beneficial owner. He has funded the asset. Further, the Supreme Court asked, what is lessor using the vehicle? By leasing it. Lessor only is using the asset, not lessee. Using does not mean driving on the road. Using means using it for your purpose of the business. Your business itself is deriving income. So, both the conditions are fulfilled. The Supreme Court said in ICDS Limited, lessor should only or is eligible to claim depreciation. Usage here means giving the vehicle on lease to the other person. The vehicle can be repossessed, the vehicle can be inspected. All these conditions are there to prove that the owner is only the lessor. Only for formality take, it is being registered in the name of the lessee. Okay. The main object is leasing. By giving the vehicle on lease, the company is said to be using it for the purpose of business. So they are only using it. And you all know, technically also you can all understand, lessee cannot claim both lease rent and depreciation as expense. He will anyhow claim the lease rent as expenditure. He cannot also claim depreciation. Okay. Hire purchase is different. We don't claim the principal as deduction. We only claim the interest as deduction. Whereas in lease, we are claiming lease rent also as an expenditure. Okay. So, repossession clause and right to inspect clearly proves that the beneficial owner is only the lessor. So, lessor can claim. Yes, yes, yes. It actually happens. It actually happens. All lease transactions, I think, has at the terminal, there is a clause which says at the end of the period, you can own the asset if you want. So it actually happens also. Right? A Sivakami, I told you about this facts of this case. It's a HUF, but the vehicle, who is in the business of running them on hire. But the vehicles are registered in the name of the individual, Sivakami. Can the HUF claim depreciation? Yes, is the answer. Because beneficial ownership is superior to legal ownership. Okay. Sufficient documents were submitted to prove that loan has been taken for purchase. Funds were made available. Income and expenses were relating to the assessee. Assessee has proved clearly that she is the beneficial owner. Hence, depreciation can be claimed. Okay. Right. There is next is classification problem. What is the rate you are claiming in office for printers? 40 scanners. How? Okay. Okay. For uh, but they are saying 40. What is the rate you are claiming for mobile phone? Right off panira, but still. Why 15? That is also computer. That is also a software. Okay. These two case laws told us what is an accessory and peripheral. That which cannot perform its operation without the other. A printer without computer, at least till last year, now it is different. A printer without a computer is just a property. So you can club it along with computer. Scanner without a computer, difficult. Whereas mobile phone and EPABX system and all, though it is linked via computer, but still it can perform its operation individually. So, in BSES Yamuna Powers, it has been held, printer, scanner and all will be enjoying. They are integral part of the computer system. So the rate of depreciation applicable for computers is allowed. Whereas in Federal Bank, they said EPABX and mobile phones are not eligible for that 40%, only 15%. Only 15%. Okay. BSES Yamuna printer scanner, that is accessory and peripheral, whereas Federal Bank mobile phone and EPABX. Okay. Goodwill, I'm not as of now taking it over because I'm sure that it is not a questionable area, but once the material comes, I'll confirm it to you. What is the difference between replacement and new asset? Sir, our friend was yesterday also asking, I have scrapped an asset. In income tax law, you cannot take it out of books. I cannot take it out of books. So, if there is an existing asset which is scrapped and replaced by a new asset, you can charge it off as expenditure. Okay. Replacement, it is as simple as first time painting and repainting. First time painting the building, you always capitalize the cost. Repainting once in 5 years, practically every year in your books of accounts. Okay. Right. Repainting is repairs, is replacement of an existing paint. So it will not be treated as capital expenditure. This can go, don't look at the quantum, look at the purpose. A compound wall was destroyed due to flood. It was replaced. The replacement cost is a revenue expenditure. It is a revenue expenditure. Assessment of firm levy will study a hotel question where they will say carpets in the hotel were replaced at a total cost of 40 lakhs. Replaced. Originally, when carpets were purchased, they would have capitalized it. Subsequently replaced, it will be charged off to revenue because the old carpet cannot go out of the books. Replacement. So in TVS Motors case, it is further held. Okay. Okay. It might not be a recent case in your, but it is a most important case. That's why I have went. Replacement does not bring a new asset into existence. It is just replacing the existing. It only puts something on which is already existing. Hence, replacement will not be treated as capital expenditure. It can be charged off. In this case, tools and dies. They're remolding kaga, they made tools and dies, which is allowed as an expenditure. Which is allowed as an expenditure.
So in accounts, we would look at whether the replacement will add to the
In
total
accounts, you will look at efficiency.
efficiency.
Okay.
Here we won't.
Here it is not necessary that you should look at efficiency, but all certain then somewhere else you will get cost, that is 115 JB format. Okay, so again and again it revolves. Okay, though this has significance only in set of chapter, but in our material it is given in this year itself. Okay, what is the order of set off of losses? Can I first set off business loss and carry the current year depreciation also as unabsorbed depreciation? So this year I have a profit of 1 lakh, depreciation of 80,000, brought forward business loss of 1 lakh. What I did is 1 lakh, I'll set it off, 80,000 I'll charge it as unabsorbed because it can be set off against any income and the indefinite period, all these things. The law said no. First set off the current year depreciation, then brought forward. Unless you provide the depreciation, you cannot say what is profit of the year. So, Mother India Refrigerator Limited case law, current year depreciation should first be deducted, then business loss, then unabsorbed, brought forward unabsorbed depreciation. Okay, so this is the length and breadth of our depreciation discussion. If you look at it, we now know normal depreciation. These are one adjustment in a question. Okay, I'm just taking it into tiny parts. When you come to the main question, this will be part of an adjustment. We know normal depreciation, additional depreciation, unabsorbed depreciation, proportionate depreciation, depreciation of electricity companies. Remember the important case laws of both Sivakami ICDS, and sometimes classification is also questioned. Okay, all the 5 case laws, try to remember. As of now, I'm not looking at goodwill. Because both these case laws are overruled by the present Finance Act, I think it will go out of material on safety purpose. I have given. Okay. The case laws just say that goodwill enjoys depreciation. Okay. One of the case law in Ariva T and D and in Dr. Ravindranath case law and all, when we look at income tax intangible, the definition of intangible, okay, when we saw yesterday, the definition of intangible is very interesting. Okay, know-how, patents, copyright, trademark. The word goodwill is not at all used. So assessing officers were all along contending goodwill is a term which is there for time immemorial. Partners bringing in goodwill, all these things we have been seeing, but it has not been used purposefully because the lawmakers does not want you to claim. But in amalgamation and various other forms of restructuring, you pay a price more than what is the net asset. So that amount for which you are paying, you are bringing in an intangible asset. I am naming it as goodwill. You can call it by any name, but I'm naming it as goodwill. So the court took a favorable stand saying, okay, goodwill, even though it is not mentioned directly, but business or commercial right can enjoy goodwill, but that is gone now. Okay, the law, the finance minister has clarified, law has been amended to specifically say goodwill is not a specified asset at all, which means goodwill depreciation cannot be claimed. That's why I say those two case laws are overruled. Okay. uh, I always feel, maybe I'm wrong in some cases, but I always feel that our material questions are ரொம்ப simple, are very unfair. Okay, so so all these practice yourself are just material questions. Okay, I'll provide the answers also tomorrow for this. Okay, so practice yourself questions you have to answer. So if I look into this, okay, I have completed the second part also. That is, the first part is 28 and 29, which talks about income. In that, we remember the case laws also, Chennai properties, Saurashtra cements, all these things. Okay, and we have completed the asset-based deduction 30, 31, 32. Our next focus is on deposit-based deduction, which has normally an expenditure will only be allowed as deduction. Will deposit be made as deduction? Yes, to promote some sectors they will allow. Okay, and followed by 35, but I'm only taking it up tomorrow morning. Okay, I'm stopping it now and I'm taking it up tomorrow morning, the deposit based deduction, etc., because the material is not yet with you. Okay, so I will meet you again by 6 a.m. tomorrow morning and continue with the deposit. Tomorrow we should be completing deposit based scientific research and specified business. Meet you
Sir,
6 a.m. Yeah. Go ahead with your question.
I have a small doubt, sir.
Yeah.
In that replacement of asset, suppose the written down value of machinery on April 1st, 2021 is 1 lakh, and they replace that existing asset at a cost of 4 lakhs. How will you calculate depreciation for that year, sir?
What you are talking about is purchase of new machine.
No, sir. They're replacing. Yes, sir. Purchasing the
That
new
is a
or
capital expenditure. That is a capital expenditure. See, buying a building is a capital expenditure. You are already having a building. Buying a new building is a capital expenditure. Only
oh,
making capital repairs like repainting of building or changing the interiors are all what I call it as replacement. In your given example, it is a capital expenditure.
so if they repaint and that is improve the quality of the machine by repainting it or refurnishing it, how do you charge, sir?
It will be charged off as a revenue, but on a case to case basis only. If it is going to increase the efficiency, for
Oh,
example, Pepsi Limited increased from 60 bottles per minute to 100 bottles per minute, a particular software, it is considered as a capital expenditure because it increases the efficiency and change the utilization of the machine itself.
okay, sir. Thank you, sir.
Yeah. we refurnish. If you are buying a new furniture, yes, it is a okay. If a furniture has a sofa and you are changing that sofa, you are changing the foam. That is known as a replacement. Don't bring in a replacement. Does not mean taking this chair out here and putting a new chair and saying, yeah, this is replaced, sir. That is not replacement. Okay, meet you tomorrow morning. All the best, friends.